Hi guys, it's Miss Thiessen here again, and today we're going to be looking at lesson 8.2 from our home finance unit, and this is on CMHC insurance, or in other words, Canadian Mortgage and Housing Corporation Insurance. So let's take a look at this together. Before you buy a home, financial institutions will do a credit assessment for you to tell you the amount of housing costs you can actually afford. So on top of your ongoing mortgage, they're going to want you to make be able to pay 20% of the value of the potential home as a down payment. So that's a lot of money, and the more expensive your home, the more you're going to have to save as a down payment if you want to make that 20%. So let's take a look at the first example here of how much 20% actually looks like. So if you wanted to buy a house valued at $150,000, now this is going to be a very, very, very low priced starter home in this area. So you're not going to find something for much less than this in the Steinbach area as a very small starter home. And if you would need to save up 20% of a down payment for that, well, let's calculate what 20% of that is. So the first thing we need to do is convert 20% into a decimal. So to convert that into a decimal, we would just divide it by 100, so we would end up with 0.2. That's the number that we need to multiply by our cost to find out what 20% actually is. Now, Miss Thiessen forgot her scientific calculator at school, and she's at home right now, so she's going to do it on her phone calculator, which you are not allowed to do, but she's going to do it now. So we're going to take our 150,000 times 0.2 or 0.2, and this will be our 20% down payment. So we have to have $30,000 saved up. Let's write that in here. We need to have $30,000 saved up in order to make a down payment of 20% on a home valued at $150,000. However, if you don't have that much saved up, you can actually still buy the house. But that means that you actually have to get your mortgage insured, because you're a greater risk of not paying your mortgage payments or not making your mortgage payments because you don't have enough saved up for the 20% down payment. So the Canadian Mortgage and Housing Corporation provides mortgage insurance, which just means that your mortgage is going to have an extra fee tacked on. So let's say you're paying $900 a month, you're going to be paying an extra, maybe, who knows, $100 or $200 a month to pay for insurance on your mortgage. So you actually have your mortgage insured. That's what they require you to do if you make a down payment of less than 20%. So if you take a look at the table here, if you can make a down payment between 15 and 20%, so not over 20, so all of these you'll notice are less than 20%, which is when you would have to get your mortgage insured. So if your down payment is anywhere between 15 and 20%, then your CMHC premium is going to be 2.8% of whatever your mortgage is. So that's how much more you're going to have to pay for insurance. If you can only pay between 10 and 15% as your down payment, you're going to have to pay 3.1% of your mortgage. If you can only pay 5 to 10% of your down payment, which is really low, then you're going to have to pay 4% of your entire mortgage as an insurance or as a premium for CMHC insurance. A little note, CMHC premiums in Manitoba have PST added on top. PST is a whopping, I think it's 7%, I believe. PST, let me just check here. I have my notes written down as what percentage each one is. It looks like I have here, yes, I'm right. PST is 7%. Sometimes I get mixed up between GST and PST. So PST is 7%. For the sake of our example, we won't be calculating this in because we don't necessarily know if the person we're talking about is purchasing a home in Manitoba. So for the purpose of our example, I'm going to leave out the PST. So let's take a look at an example here. It says if Kim had a $15,000 down payment available, how much would she have to pay for the CMHC insurance on a house that costs $264,500? So first we need to find out how much she actually needs to borrow. So how much does she need to borrow? Well, you guys know we've done this plenty of times already. We need to take the total cost of the home and subtract the down payment from that. So if we take our $264,500 and subtract our $15,000 down payment, how much do we end up actually having to pay? Or how much does she need to take out as a mortgage? She'll have to take out $249,500. So that will be the amount that she needs to borrow. So now the next question is to find out what amount this is as a percentage of the total cost. So what do we do to find out what percentage this is of this? Well, we're going to take our down payment, or we're going to take our mortgage that we have to borrow and divide it by the total cost of the house. So we'll take our $249,500, divide it by $264,500. This will give us a percentage. Okay, so if we do that and we divide that, we get a number. Oh, it's not a dollar amount. Sorry about that, not a dollar amount. It's going to be a decimal. So we've got 0.9432. Okay, that's a decimal. Remember, if we want to change this to a percentage to figure out what the percentage is, all we need to do is multiply it by 100. So we're going to take our 9432 times 100. And as a percentage, the percentage that she's borrowing of the house is 94.32%. So we need to determine what her premium rate is going to be here. So what is her premium rate? Well, let's take a look at our insurance premium table here. So the financing required, if we take a look, we got 94.32%. So that we're going to look at it under financing required. What row does that fit into? It looks like it's between 90 to 95%, which means she's going to be paying a CMHC premium of 4% of her mortgage. So here we would write 4%. So she needs to pay an extra 4% of her mortgage on top of her actual mortgage. So it says now to calculate the amount payable for CMHC insurance. Well, to do that, we need to find out how much she's going to borrow, and we did that already. We know how much she's going to borrow. She's going to borrow $249,500, and she needs to pay an extra 4% of that. So to find out how much 4% of this is, we need to take our decimal. We're going to take 4%. We divide it by 100 to change it into a decimal. Remember, we're doing the opposite of making it into a percent. We're making it into a decimal. So we divide by 100 and we end up with 0.04. So that's the number that we need to multiply by the amount borrowed. So times 0.04, this will be the cost of her CMHC insurance. So on top of her mortgage payments, on top of the mortgage that she's borrowing, to insure her mortgage, she will need to pay an extra $9,980. Okay. Now, often this amount is added to the mortgage, so you'll make it in payments, and if it's spread out over a period of like 25 years, it doesn't seem like it's that much on top of your mortgage, but you are still paying extra because you were unable to make that 20% down payment. So just make a note here, this is often just added onto the mortgage and is made in payments just like a mortgage is. Okay? This is going to be important later on when we go over closing costs as well. All right, thanks for watching.